On May 18th, 2026, the SBA announced that the cumulative guarantee limit for 7A and 504 loans is increasing from $5 million to $10 million effective July 4th. That's the headline you've seen. And if you're in the process of acquiring a business right now or thinking about it, your first question is probably, what does this actually change for my deal? That's what I want to walk you through today. Not the press release version, the version that matters when you're sitting across the table from a lender. I've been in commercial banking and lending for roughly 30 years. Roughly half that time as a bank lending officer and credit officer, and 16 years running Commercial Lending X. We've closed over 828 transactions totaling over $1 billion. I tell you that not to brag, but so that you understand when I explain how a rule change affects deals, I'm drawing on pattern recognitions from tens of thousands of transactions underwritten and reviewed over the years. Let me start with the basics and build from there. The SBA cumulative guarantee limit is the total amount of SBA guaranteed debt a borrower can have outstanding at any one time, and that is within a specific NAICS code. I want to emphasize two things in that sentence. First, the word outstanding. This is not a lifetime cap. If you took a $3 million SBA loan 5 years ago and you paid it down to $1 million, your outstanding balance is $1 million. Your available capacity under the old rule was $4 million. Under the new rules, it's now $9 million. Secondly, I want to emphasize the words per NAICS code. If you own a landscaping company under one NAICS code and a staffing firm under another, those are two separate buckets. Each gets its own $10 million ceiling. That has been true for the last couple of years, and at this point, we do not expect it to change. What has changed is the size of each bucket, as well as how the two main programs interact within that. This is where I spend the most time with clients, because it's the most misunderstood program in SBA lending. An SBA 504 loan is not one loan. It's two separate loans packaged together for one project. The first loan is a conventional bank loan. A regular commercial bank or credit union provides 50% of the cost for the project. This is not SBA money. The bank underwrites it, the bank holds the loan, the bank sets the terms. The bank sits in the first mortgage position on the real estate or first lien position on any equipment securing the loan. The second loan is the SBA 504 portion. A certified development corporation, called a CDC, provides 40% of the project cost. That CDC is an intermediary that sits between the SBA and the bank specifically to manage the SBA 504 program for the SBA. The CDC loan sits in a second mortgage or lien position to the bank. The CDC portion is backed by a government guarantee. It's the only part that counts against your cumulative guarantee limit. Then the borrower brings the remaining 10% in equity. In some cases, the bank and SBA may allow a seller note to potentially reduce this equity if it's a purchase transaction. Now, 504 loans are specifically for owner-occupied commercial real estate and major fixed assets like equipment. You must occupy at least 51% of the property to qualify. This is not a general purpose loan. You cannot use a 504 loan for working capital, inventory, business acquisitions, or other miscellaneous business purposes. But if you're doing a business acquisition that includes real estate or significant equipment, those portions can be financed through an SBA 504 loan. One important detail to note: if you're purchasing real estate with a 504 loan and there's a change of business ownership happening simultaneously, the down payment requirement increases from 10% to 15%, and the SBA 504 portion of the project drops down to 35% instead of the standard 40%. Most buyers don't learn about the higher required down payment until well into the process, so we want to be sure you know it now. This is where use of the SBA 504 program gets interesting. Your cumulative SBA limit was $5 million previously. Now just your SBA 504 limit is $5 million. That $5 million represents, on average, 40% of the total project cost. If the SBA piece is $5 million and that's 40% of the project, then your total project cost can be as high as $12.5 million. So the $5 million limit was never really $5 million for 504 purposes. It was $12.5 million in total project value. The leverage built into the two-loan structure multiplied it. But there's another structure to consider. If the conventional bank is willing to take on a higher percentage of the debt with an SBA 504 loan, say 60% instead of the standard 50%, that reduces the SBA portion to 30% of the project. The borrower still only brings 10%. In this example, a $5 million SBA limit translates to a $16.7 million total project, still with only 10% down from a borrower, using the combination of SBA debt and conventional debt. Not every bank will do this. The conventional lender has to be comfortable taking on a larger position. But this is how experienced borrowers and advisors structure large 504 transactions. And the new cumulative limit makes these structures viable for more transactions. Let me put these two programs next to each other because they serve different purposes and are structured differently. So understanding the distinction is critical to understanding the new rules. The SBA 7A program can be used for really any general business purpose. That includes business acquisitions, working capital, equipment, inventory, leasehold improvements, debt refinances, owner-occupied real estate, and more. Really, any reason a business could use debt, the SBA 7A loan program likely covers it. With the SBA 7A program, there's a maximum of $5 million per individual loan. Most SBA loans are variable rate, typically from the prime rate to prime plus 2.75%, which today would be an interest rate range of 6.75 to 9.5%. A 10-year amortization is standard for most SBA 7A loans, extending to 25 years if the use of loan proceeds is 51% or more for real estate. The use of proceeds is an important distinction. If a business acquisition is $3.2 million and the real estate acquisition is $3 million, if there is a seller note for $250,000 or more, if that seller note is put against the business assets, the use of loan proceeds would now be $2.95 million for the business and $3 million for the real estate, which would open up that transaction for the longer 25-year amortization on all of the debt. The 504 program is specifically for owner-occupied real estate and major equipment, excluding vehicles. It has a two-loan structure I previously discussed. The SBA portion carries a fixed rate, which is typically below market, and is 10 years on equipment and can be 20 or 25 years on real estate based on borrower choice. If both real estate and equipment are involved, and 75% or more of the dollars are going towards real estate, all of the debt can be over 20 to 25 years. If more than 25% of the dollars are going for equipment, then there needs to be two SBA 504 loans, one at 10 years for the equipment and another at 20 or 25 years for the real estate. The bank portion of an SBA 504 must provide for a 10-year loan term with a 10-year amortization for equipment and at least a 20 to 25-year amortization for real estate. We even have a few lending partners offering a 30-year amortization on the bank portion of a SBA 504 loan for real estate. The bank typically provides for at least a 5-year fixed rate, but that rate can be fixed for 7 or 10 years. And in some cases, it may even be a variable rate adjusting every year to every 5 years. The structural change from this recent SBA announcement that I think matters more than the dollar increase is the fact that the programs are now decoupled. Previously, your 7A outstanding balance reduced your available 504 capacity. They shared one pool of money. If you had $3 million in 7A debt, you had $2 million left for the 504. That's gone. Now the SBA 7A and 504 are separate buckets. You have $5 million on the 7A side and $5 million on the 504 side, and they're independent of each other. For a borrower acquiring a business with a 7A loan and buying the real estate with a 504 loan, this means both programs can operate at their full capacity of $10 million. Let me walk through 8 scenarios so you can see how this applies to different deal types. Scenario 1, first-time buyer, straightforward business acquisition. No real estate, no equipment. Most of the purchase price is going to the goodwill value of the business. It's a $7 million purchase price. This is a 7A transaction, and the buyer will still be capped at $5 million. There are options to get additional debt via pari passu loan, but that comes with much higher underwriting criteria, and less than 5% of SBA lenders will even do pari passu loans. But there is no way to get SBA debt higher for this type of business acquisition. Scenario 2, a business acquisition plus the real estate, with $5 million being paid for each the real estate and business for a total of $10 million. You can split it and do a 7A for $5 million for the business purchase and a 504 for $5 million for the building. Under old rules, these competed for the same $5 million pool. Now they don't. The 7A piece uses 7A capacity, the 504 piece uses 504 capacity from separate buckets. Scenario 3, second acquisition in the same NAICS code. You already have $3 million outstanding in 7A debt from your first deal. Old rules, you would have $2 million left. New rules, you have $2 million left on the SBA 7A loan program and $5 million left on the SBA 504 program if any portion of the deal would qualify for SBA 504 financing. Scenario 4, second acquisition in a different NAICS code. Each NAICS code gets its own $10 million ceiling, as we at least understand the rule at this time. Your first deal's balance is irrelevant to the second deal's capacity. This has been the case for a couple of years now, but it's worth repeating because most buyers still don't know it. Scenario 5, a business at its SBA 7A limit wants to buy the property they occupy. They now have $5 million in SBA financing to buy that property. Based on the SBA 504 leverage with conventional bank debt, that would allow up to a property purchase of $12.5 million, with the bank only at the 50% limit on the purchase price. Scenario 6, a business already has its SBA 504 limit of $5 million, looking to purchase another business or get working capital. That business can now qualify for $5 million in SBA 7A financing for that acquisition or working capital need. Scenario 7, a manufacturing company already at its SBA 504 limit of $5 million looking to purchase additional equipment or a building to expand into. Manufacturers under NAICS codes 31, 32, and 33 get $5.5 million per additional SBA 504 project and can start a new project every 6 months. Scenario 8, a manufacturing company already at its SBA 504 limit of $5 million looking to acquire another business with equipment and/or real estate. Manufacturers under NAICS codes 31, 32, and 33 get $5.5 million per additional SBA 504 project and can start a new project every 6 months for the real estate and equipment, and can now access another $5 million via the SBA loan program to fund working capital and the goodwill purchase of another business. Scenario 9, a large project using expanded 504 leverage. $15 million property. Bank takes 60%, SBA takes 30%, the borrower brings 10% equity. The SBA piece is $4.5 million, well under the new $10 million limit. The total project gets funded with only 10% down. This does require a bank to take a larger piece on the 504 loan, but the structure is available. I touched on this in the various scenarios, but manufacturers deserve their own mention. NAICS codes 31, 32, and 33 cover manufacturing. There's also new project eligibility every 6 months for additional equipment or facilities and partial fee waivers. There's also a separate bill in the Senate right now, the Made in America Manufacturing Finance Act, that already passed a House, and that would increase this limit to $10 million for manufacturing. I'll update you when there's movement on that bill. I want to be direct about this because it's the most important part of this video. The dollar ceiling changed. The underwriting requirements did not. Cash flow still has to support the debt service. A $10 million SBA limit doesn't help if the business generates enough cash flow to service only a $3 million loan. If that is the case, the total amount you can borrow is $3 million. Collateral requirements haven't changed. Personal guarantees are still required for anyone with a 20% or greater ownership interest in either the business or real estate, and credit standards haven't moved. The bank still has to say yes to your loan. The SBA guarantees a portion of the loan, but the bank is still making a lending decision. They're still underwriting the deal, they're still evaluating the borrower. I see too many buyers get excited about a rule change and forget that the fundamentals of getting approved haven't shifted. It's also important to note that the SBA has not released the final rule language yet. The announcement laid out the framework. The specific implementation, details, definitions, and any exceptions will be in the final rule. I expect it within the next few weeks, and I'll do a follow-up video when it drops. If you're actively looking at a deal, here's what I tell you in a phone call. First, know your current outstanding guaranteed balances. Not the original loan amounts, the current balances, and know them by NAICS code for your businesses. Second, understand which program fits your deal. If it's a business acquisition without real estate, that's going to be an SBA 7A loan. If it includes real estate or major equipment, now you may be able to use the 504 loan program. If it's both, you may be able to use both programs, and they no longer compete for the same capacity. Third, don't structure your deal around the new limit until the final rule is published. The announcement is clear in its direction, but the details matter, and details come in the final rule. Fourth, talk to someone who does this full time. And I don't mean that as a sales pitch, I mean it as practical advice. Whether you talk to me or another advisor, understand the programs. I should disclose to you, as I always do, we are a commercial loan brokerage. Commercial Lending X earns a success fee only when your loan closes. Zero is charged up front. That's my incentive, and you should know it when someone is explaining a financial product to you. What I can offer you is 30 years of commercial banking experience, roughly half of which is as a lending and credit officer, plus 16 years running Commercial Lending X. Over 800 closed transactions, we have access to over 500 lending partners, including 100 plus SBA 7A lending partners, plus all of the banks we work with that do SBA 504 financing. I will tell you on day one exactly what the bank would tell you in month 3. If your deal works, I'll show you the best structure, the best pricing, and the right lending partners. If it doesn't work, I'll tell you that too, before you spend $20,000 on diligence to find out the hard way. Here at Commercial Lending X, we will help you find the best structure, pricing, and lending partners for your transaction. We look forward to the chance to assist you.